Hello and welcome to the Eide Bailey Tax News and Views podcast, exploring current tax topics of interest and providing tax insight to help you make an informed decision. During this session, you will learn more about the new pass-through rules with Adam Sweet, a National Tax Office principal who leads our pass-through entity consulting practice. Adam, I know you've been busy helping clients figure out how the new pass-through rules impact their situation. I'm wondering if you could tell us why Congress enacted the new Section 199A rules.
Sure, Kate. So the new 20% deduction, which affects S corporations, partnerships, sole proprietorships, Schedule E, Schedule C filers, and so forth, we commonly refer to these types of businesses as flow-through entities. They passed it for those entities because the corporate rate was cut to 21% from 35%. And in order to equalize the treatment, they also provided for this 20% deduction so that the tax paid by the owners of flow-through entities would also get a tax benefit from flow-through form. And it's important because most businesses today are in the pass-through form. Most businesses are not in the C corporation form. So in order for tax reform to be equitable, they had to come up with this tax deduction for pass-through entities to not equalize the treatment, but to also provide a tax benefit to the pass-through entities.
So given the new 21% corporate tax rate, should businesses consider converting to a C corporation for tax purposes?
Well, it's a good question because, and it's probably one of the most popular questions we have received over the last 6 months, or last 4 months since tax reform was passed in December. And it's interesting because over the last 30 years, since the last piece of large tax reform legislation in 1986, in almost all circumstances, it was better to be a flow-through entity rather than a C corporation because C corporations are subject to a double layer of tax. You pay tax at the entity level, and then you pay tax at the shareholder level when earnings are paid out to the shareholders. And historically, this combined double tax rate was up to 10 percentage points higher than a rate paid by owners of flow-through entities. So really, in most circumstances, you would be a flow-through entity unless you were forced to be a corporation. But now that the C corporation rate has been dropped dramatically to the flat 21%, it's a much closer question because even with the double layer of tax paid by C corporations, because of this new 21% rate, that the spread between the tax paid by the owner of a flow-through business and the tax paid by the owner of a C corporation is very close. Factors that would still favor the flow-through form, so if there's a client out there, if there's someone out there and they're in a flow-through form and thinking about going the C corporation route, if that business is eligible for the 20% deduction on certain pass-through income, then that's going to favor the flow-through form. And also, there's certain advantages to being a flow-through because if there's losses incurred by the business, for instance, they're going to flow through to the partner. But admittedly, it's a much closer question now when you're looking to either form a company or convert a company. It's a much closer question than it has been for the last 30 years, whether you form a C corporation or a flow-through entity.
So who can make use of the 20% deduction under the new Section 199A?
So, tax reform, they started off with a pretty simple idea of trying to provide reduced rates and more money in people's pocket, and it all sounds great. And then you get tax reform, which is many hundreds of pages, and you learn that the devil is truly in the details. And so for starters, for the 20% deduction, you only get a 20% deduction if you have what's called qualified business income, QBI for short. And Congress does not tell us what QBI income is. Instead, Congress tells us what QBI income is not. And the first thing that it's not investment income. So it's not capital gains, it's not dividends, it's not interest from investments. All the different types of income that come from investment activities, that income does not produce a 20% deduction. Also, wages, if you receive a W-2 wage or a guaranteed payment from a partnership, those also do not get put into the pot of the QBI. The other large carve-out is even for active businesses, Congress said that service-based businesses do not qualify for the 20% deduction. And they gave us 8 or 10 different examples in this statute of what a service-based business is, and many of them, not surprisingly, are doctors, lawyers, accountants, athletes, consultants, typical professions that depend upon kind of the expertise of the individual to further the business. And Congress said, we don't want these types of businesses to get the benefit of the 20% deduction. So that's fair enough. You could quibble about whether those businesses should get the deduction, but that's easy enough to understand. The problem is that the last part, they also said, they gave us a list of 10 things that are a service-based business, but at the last part of the statute, they also say that a service-based business is any business where the principal asset of the business is the reputation or skill of employees or owners. And the big open question there is, what does that mean? Because if you read that to the extreme, really that last part could swallow every business in America. Because what business in America doesn't depend on the reputation or skill of its employees or owners? Now, clearly, Congress did not mean to carve out every business from the benefit of the 20% deduction, but it'll really be up to the IRS and the Treasury Department this summer to provide guidance on what it means to have a service-based business. If you don't fall into the enumerated categories of a lawyer, a doctor, et cetera, but you have some service component to your business, we're going to have some type of test or examples or something from the IRS that helps us decide or helps us determine if a business qualifies. And the two other things to quickly mention, and we won't get into too much detail, but even if you have QBI, the 20% deduction is not unlimited. The first thing is that you have to pay wages with the QBI. If 50% of the wages paid along with that business do not equal the 20% deduction, then your deduction can be limited. And there's also a limitation for businesses that don't pay wages. There's a limitation that looks to the unadjusted basis and depreciable property. So there are limitations out there to pay attention to, even if you have QBI. And then finally, there's a pretty generous phase out. If you're married filing joint and you have taxable income under $315,000, or if you're a single filer and you have taxable income under $157,000, you don't have to worry about having a service-based business, and you don't have to worry about paying wages, that you will get the 20% deduction. So if you're a lawyer and you have taxable income of $300,000, total taxable income of $300,000, you'll be able to get the 20% deduction. Whereas if you're a lawyer making $500,000 a year, you would not get the deduction.
So you mentioned the service-based business being one of those open questions that we're waiting for the IRS to respond to. Are there any other open questions regarding the new Section 199A?
There are. I mean, the big one is, just as I mentioned, what does it mean to have a service-based business? But I think the other open question that the IRS and Treasury Department are going to have to address this summer is, how do you define a business? So we have qualified business income comes from a business, but how do you define a business? And what I mean by that is, if you have a single entity, if you have an S corporation that holds several different lines of businesses, maybe it has a service component and maybe it has a manufacturing component underneath the S corporation. Will the IRS treat that as two separate businesses, or will the IRS say it's a single business, it's a single S corporation on top, so there's only one business line, and because there's a service component to it, the service component is going to taint all of the business, and therefore the 20% deduction will not be eligible. There's a lot of guesses right now. Maybe the IRS perhaps will look to the Section 469 passive activity rules for defining a business, but the statute refers to, the new statute refers to businesses. It doesn't really refer to activities, so maybe 469 is not the answer. But hopefully, again, similar to the service-based business question, hopefully this summer we'll have some guidance from the IRS on how to define business. And this will be very important for clients who are looking to potentially restructure or to move things around. You're going to want to wait to do that probably until we have more guidance from the IRS.
Okay, so do you think clients should consider restructuring to make use of the new Section 199A?
So I think if you clearly have a structure that does not work under the statute. So let's just say, for instance, you could have a service-based business, and you might say that it's a law firm or it's an accounting firm. You might say, well, this clearly is not going to generate good QBI income. But you might look into that business and say, well, there's components of this business that we could separate. Maybe we have, maybe there's some administrative functions. Maybe there's a trademark. Maybe there's other things that could be placed in a separate entity, and given the right facts and the right application of the law, perhaps by placing it in the separate entity that you could generate good QBI and get the 20% deduction. But for a lot of people, if you're in the gray area of just trying to figure out whether you're a service-based business, if you're trying to figure out whether what you have is one business or two businesses or multiple businesses, I think the best practice is to wait for guidance from the IRS this summer, because you wouldn't want to pay money now and reorganize and find out you didn't have to do it, or find out that the reorganization puts you in a worse place. So I think for quite a number of our clients out there, they're meeting with us now to talk about tax reform. We're considering things, we're modeling things out, but we're maybe also waiting for a couple of months before we make a final decision on whether to restructure.
Thank you for sharing your expertise, Adam, and for listening in. Please visit eidebailey.com or contact Adam Sweet directly with questions or comments about this session. If you have a topic you'd like us to discuss during a future recording, please email nationaltaxoffice@eidebailey.com. We look forward to hearing from you.